Hello and greetings. Welcome to Dividend Blasters. This briefing is about the best dividend growth investments one should buy in February of 2023. Let's answer the question, why invest in dividend growth stocks? Well, first and foremost, you want to establish passive income. The objective there should be to achieve financial independence. Having an extra income stream or revenue stream separate and distinct from your job should be a prudent approach to getting there. Secondly, this could actually act as a hedge against inflation. Everybody who goes to the grocery store or buys gas today understands that inflation is a tax on your earnings, your hard earnings. Having an extra revenue stream can help hedge against that. Third, building wealth over time. This is a sound and rational approach, and it's a little bit more of a steady approach than stock picking the next moonshot. Everybody would love to pick the next Microsoft or Apple, but it's very difficult. It's very difficult to find out what those investments are at the get-go versus building wealth over time through proven investments that have years and years of successful financial performance and paying dividends resulting from that performance is a sound approach. And that leads to the last point, and that is about dividend reinvestment planning, or the DRIP. Ideally, what you want to do here is to continually reinvest your dividend. So you're building a dividend snowball. So you get a dividend, you reinvest it into your holdings grow, you get another dividend because the holdings are bigger, the dividend gets bigger. The dividend adds to the holdings and it continues to grow. That combined with time works in your favor. So why am I focusing on February? The reason why I'm focusing on February is that there are a number of stocks and ETFs that are going ex-dividend date this month. That's why this is important. If you don't have any shares in an investment that you want and you can get your purchase in before the ex-dividend date, that will entitle you to a dividend this quarter. If you miss the dividend date, the ex-dividend date, but you buy it, that's great. You're just going to have to wait another quarter. Now, let me just caveat what I'm saying here, that there are some of these stocks that I'm going to cover have already gone ex-dividend. It's February 7th, 2023. So there's been 7 days. However, these are all really good investments, and I'd urge you to take a close look at each and every one of them before you make your decision. So 16 of these investments, in my judgment, are ones that you ought to take a look at. And some of the key criteria that I look at are the following. The ex-dividend date. Okay, we already talked a little bit about that. Let's go to the dividend yield percentage. This is, I would say, one of the most important metrics that dividend growth investors like you and I should be looking at. How much, percentage-wise, can we as investors expect from the company with regards to the price of the stock? I typically like to see something in the 2 to 3% range. Some of these are less than 2 to 3%, but there is a compensating factor, and that's the next criteria, the dividend growth rate percentage. If I see a stock investment with a modest yield, but a significantly higher dividend growth rate, and they've maintained a high growth rate for a long period of time, you've got my interest. I would typically like to see, when combining the yield and the growth rate, I would like to see something around the area of around 10%. So if I see a yield of 3% and I see a growth rate of 6 or 7%, you got my interest. the dividend payout ratio. General rule of thumb is 20 to 60, sometimes 20 to 80%. How much of percentage-wise of net income is the company paying dividends? You don't want to see a ratio that's too high. I like to see something in that range. If I see something that's more than 80%, I tend to be reluctant to invest. If I see something in the 20, 30, 40% range, I'm more excited than if I see something above 60. But I have gone above 60. So that's kind of what you want to look at. You want to make sure that the company is generating enough revenue, has enough cash to maintain the dividend payment. And if it's too high, you want to look at some other metrics like funds from operations or cash flow. Dividend growth streak. This is really important. You want to know that the company that you're investing in has a track record of continuously and consistently increasing their dividend yield. You're going to hear me talk a little bit about dividend aristocrats and dividend kings. Companies that are classified as a dividend aristocrat have essentially been increasing their dividend yield for 25 or more consecutive years. That is an impressive designation. You're going to see companies like AbbVie, the drug company, or Abbott Laboratories, also a drug company, more drug equipment. Chevron, the big oil company, also an aristocrat. Those are big companies that are successful at growing their dividend to their shareholders. There are some companies that have been doing it even longer. One that comes to mind is Johnson & Johnson, ticker symbol JNJ. They have been increasing their annual dividend for 60 years, more than 50, which is what is required for that designation. So they've been doing it for 60 years. That to me is outstanding. They're a dividend king. And there's a handful of dividend kings, and I intend to do another video or two where I focus solely on dividend aristocrats and dividend kings and what sets them apart from other companies. Last metric, cash flow. I'm always interested in cash flow. Cash is the lifeblood of a company. I like to see cash increasing in recent years, last 3 years typically. Sometimes if I see it decreasing, I'll look a little deeper. If the company is smaller, but if they have promise, I might invest a little bit of money in the company. But I like to see a nice, robust cash flow and growing, hopefully. Let me make a disclaimer. I am not a financial advisor. The purpose of this is for education and entertainment, and this solely reflects my own assessment of these investments and my personal opinions. So I urge you to do your own research, do your due diligence, and consult with a professional financial advisor prior to making any investments. That's what I do. But I've been doing this on my own with financial advice for more than 30 years. And I love doing it, and I've gotten pretty good at it, but I'm not a professional financial advisor. So take that advice if you would, and let's move on. Okay, we're going to start the countdown. Number 16, I think we've all heard of Costco, formerly known as Costco Wholesale. This is a wonderful company. They were founded in 1976 and they're based in Washington State. They operate membership warehouses. That's really key. Membership. You have to sign up and pay just to get into the building and shop. So that to me tells you that this company knows how to generate cash. They know how to make money. They got warehouses not only in the U.S. but in Puerto Rico, which is part of the U.S., but it's a territory, Canada, the UK, Mexico, Japan, Korea, Australia, Spain, France, Iceland, China and Taiwan. Uh, they deliver tons of merchandise and services. Too many to mention here. You can do your research. They currently have over 838 membership warehouses. They got 578 of them in the U.S. and Puerto Rico, over 107 in Canada, 40 in Mexico, 31 in Japan. The list goes on and on. You look at this here, maybe one of the first things that stands out is the price. It's an expensive stock. It's over $500 a share. Market cap is big. This is a big company, over 229 billion. The PE ratio is a little bit high. A lot of people love Costco, and the price has been bid up over the years. I like the beta. The beta is a measure of risk, and compare it to the S&P 500. And basically, what this tells us is that this stock exhibits less volatility relative to the S&P 500. This is a safe investment. Let's talk about dividends. The yield is small. It's less than 1%. It's less than half of what its competitors in its sector offer. But look at that dividend growth rate. That is a thing of beauty. It's over 12%. It's almost 3 times as much as its competitors. That gives me serious pause to go and look at this and say, hey, I want to get some of that Costco stock. I also like that the dividend payout ratio is 26%. It's not too high. They're meeting their dividend, and as you can see, they've been meeting it for more than 18 years. They're meeting it easily. It's a quarterly dividend company. They've already gone ex-dividend February 2nd. That means nothing to me. I am going to buy some Costco stock when I get paid next week, and I'm looking forward to it. Next one, New York Community Bancorp. This is a formerly known as Queens County Bancorp, and it was established in 1859, and it's based in Hicksville, New York. They're a holding company for New York Community Bank, and they not only provide banking for the Metro New York area, but also New Jersey, Ohio, Florida, and Arizona. They got a nice network of over 237 branches and over 300 ATM locations. They do business banking where they serve mid and small businesses, small and mid-sized businesses, and professional associations. I like this. Their cash has been a little bit up and down over the last couple of years, but it's a fairly cheap investment. It's $10 a share. The PE ratio is low. The beta is equivalent to the volatility of the S&P 500. Their market cap is almost $7 billion. This is not a big company, but it's a nice company. They've been around a long time, and they have a loyal customer base. They have a very healthy dividend yield, almost 7%. The dividend growth rate is small. Sometimes I break my rule of thumb. If I see a company that has a very loyal customer base and they're a steady operating concern, I see that here. They've been around a while. They've already gone ex-dividend. I have several shares of this company. I like the fact that I can pay a low price and get a nice dividend of about 7%. So I think that is actually pretty decent. I don't put a lot of money in this, but I put a good amount, and I look forward to getting that dividend quarterly. Next one is Horizon Technology Finance Corporation, ticker symbol HRZN. This is what we call a business development company. They specialize in activities like lending and investing in development stage investments. They focus on things like securing debt and doing venture capital lending to companies in the technology, life science, healthcare information and services, clean tech and sustainability industries. They focus solely on the United States is their target areas to lend money. This is a very small company. Their market cap is only 332 million. What I will look for sometimes in smaller companies is the opportunity for growth. This is one of those opportunities, and they do pay a dividend, and it's a pretty decent one. It's over 10%. The price is a little more than 12.50 a share, which I like. The beta is a little bit higher, so there's a little bit more risk and volatility involved. And I think that's why the price is fairly cheap. I've had this stock for several months and I'm pretty happy with it. I'm watching it closely. You'll notice that the growth rate is not very high. So we watch that. We want to keep a lookout. And again, the payout ratio is a little bit high. I do make an exception in certain cases. This is one of them. I like the fact that this is a monthly dividend company. I have several shares of this. But again, it's a fairly cheap stock, and it's something that once in a while I will grab a bunch for myself, and I will enjoy the ride. And I'm making a little bit of money on this. It is going ex-dividend on February 16th, so if you wanted to get a dividend this quarter, you have about a week. Next one. STAG Industrial. Now, STAG is a REIT, or a real estate investment trust. And if you invest in REITs like Realty Income, which I have, and I'm not covering today, which is known as the monthly dividend company, you've probably heard of STAG. STAG, while Realty Income is a commercial REIT, and they lease space to places like Target and Walmart, STAG leases space to warehouse companies that need warehouse space. And one of their biggest customers is Amazon, Amazon.com. They are a good company in the REIT industry. And what I like about this is that the price is fairly cheap. It's about 36 bucks. Market cap is a little under 7 billion. For REITs, we don't necessarily look at PE. We look at something called price over funds from operation ratio. It's a little over 16. That's not bad for this industry sector. One of the things that I like to look at is the fact that a REIT like STAG has a lot of lease agreements that may go for several years. So they've got customers that are going to be paying rent for maybe 10, 15, 20 years, and they got a lot of them. That's going to translate to fairly stable dividend payments to investors like you and me. When you look at the yield, it's not bad. It's about 4%. That's pretty good. It's a little bit less than competitors in their sector. The growth rate is not high, and that's typically what you're going to see in REITs. You're going to see a low growth rate, but you're going to see a steady dividend payment. Dividend payout ratio, I'm just showing that here for illustrative purposes. This is not a good metric for REITs. We typically want to look at things like cash flow. We also want to look at the price over funds from operations ratio that I just covered. So I just put that there for illustrative purposes. Another good metric, however, is the dividend growth streak, which is something that we look for in all of our investments. They've been increasing the dividend for 11 years. So these have not been significant increases. They're modest increases, but they are increases. So they're there for the investor. This is a monthly dividend company, which I like. You know, if you're approaching retirement and you're living off dividends, sometimes it's hard to space out your dividend payments because a lot of companies pay quarterly. And you're like, okay, well, this one pays in January, this one pays in March, this one pays in, June, this one pays in September. What about those months in between? Sometimes that's hard to figure out. If you're not good at budgeting those dollars, sometimes you need to include some of these monthly dividend companies. And you're going to find that with some of the REITs and some of the business development companies. Next one. Next one is Truist Financial Corporation. If you are familiar with BB&T and Sunstar Bank, Truist is the result of a merger between the two. Truist was actually has been around a long time. They're headquartered in Charlotte, North Carolina. They were founded in 1872. They got over 2,500 offices throughout the United States. Uh, this is a fairly big bank. They got a big market cap of 65 billion. PE ratio is not high; it's 10. Beta is a little bit above the S&P 500 at 1.1. And the price is about $50 a share. For me, that's a good price. Um, I will intend, and I've done some of this already, to do a deep dive in some of these stocks as far as doing a valuation of the price of this one, which I'm really interested in going deeper. But I've gone deep enough, and I can tell you, I think this is a good buy. But some stocks out there are undervalued, some are overvalued, and that will be in a future video. What I do like about this is the dividend yield is a healthy almost 4.2%, and the growth rate is almost 10. So that's the rule. Bigger dividend growth rate, a healthy, modest, but a healthy annual yield, which is nice. That dividend payout ratio is in that sweet spot around 40%. This dividend growth streak is nice. They've been steadily increasing their dividends for 8 consecutive years. They're there for you. It's a quarterly dividend company. They are going ex-dividend in a couple of days. So if you wanted to get a dividend this quarter, you need to move. Next one is Valero Energy. One thing you're going to notice is that I have a handful of energy stocks, oil and gas companies in here. And the reason why I have them is they've been delivering a lot of cash. We've gone to the gas station the last year or two, and we've seen gas prices increase. That's because the price of oil, the barrel of oil, has gone up. And that has been a cash cow for these oil and gas companies. What better way to get some of your money back from buying gas is to invest in some of them. And in looking at some of these companies, I've seen increasing cash flow over the last few years. Some of it has been really impressive. Some of the stocks are a little bit pricey. I think some of them are worth it. I'd say Valero is worth it. They got a pretty big market cap of almost 50 billion. The PE ratio is not high. It's under 6. You're going to see a little bit of a higher beta. And so with these gas and oil companies, there's going to be a little bit more volatility. I'm willing to accept that because I am really confident with Valero's cash flow. I like the dividend yield. It's around 3.19%. I actually think it might be a little higher because I believe that this yield really only covers regular dividends. If I go back to my records, I believe they had more than 4 quarterly dividends. I believe they had a number of special dividends. I'm certain that ConocoPhillips has, and I believe Valero has also. So you could be getting 8 dividend payments for some of these stocks. The dividend growth rate is high. It's almost 7%. The payout ratio is low. That should tell you something. They're growing their dividend rate, and yet the ratio is low. They're doing it easily. They did have a little bit of a blip during the pandemic where their dividend didn't increase, but they seem to be back on track. This, to me, is a good company. I have several shares of it. I like it. The dividend, ex-dividend date is next week. So if you're not in and you wanted to go in, you have about a week or so to go and buy in. Next one, another energy company, Marathon Petroleum, ticker symbol MPC. Nice market caps. This one is also a little over 50 billion. PE ratio is not high, a little over 6. Beta is a little lower than the last one. It's about 1.1. So it's going to have a little bit more volatility than the S&P 500, a little less than the last one. Taking a look at the dividend metrics, the yield is a little bit more than 2.5%, but look at that beautiful growth rate. more than 10%, which is to me a thing of beauty. I love to see that. I love to see the lower payout ratios and the high dividend growth rate. I think that tells me this company is making their dividend and they're increasing it, and there's not a problem there. Now, again, their dividend growth streak is 1 year. Them, like many companies, have had some issues during the pandemic, but in looking at their cash flow, they are back on track and they're doing really well. They're going ex-dividend on the 15th, so you got about a week or so. I don't own any shares of Marathon, but my intention is to go and buy some because I think this is a wonderful company. I would say one of my favorites is this one here, and I did mention it, is ConocoPhillips. A little bit bigger, market cap over 137 billion. The PE ratio is a little higher. It's over 7, a little bit higher beta. So you're going to have a little bit more volatility than the S&P 500. The price is $112. So these are a little bit pricey. The dividend yield is a little bit lower, but again, it's showing 1.9%, but I have an asterisk. Don't be fooled by that. Go and look at their dividend history. They had more than 4 quarterly dividends last year. I think over the last 2 years, actually, they had 8. They had the 4 quarterlies, and then they had several special dividends in between those quarterlies. That growth rate is over 12%. It's a thing of beauty. I love the payout ratio. It's only 33%. Growth streak, 2 years. They had a little bit of a blip during the pandemic. They're back on track. Ex-dividend date, February 13th. I have several shares of this. I'm not selling anytime soon. And I'm actually a regular investor in this company. And I always like to buy a little bit. And what I do is this one especially, but all of my investments, I'm dripping. And let me make that point. Every time I get a dividend, it's automatically reinvested in the stock. And so my holdings grow. And then when the next quarter dividend comes out, I'm going to get a bigger dividend. And it's going to go back into the holdings and grow my holdings. And then the next quarter, I'm going to get a bigger dividend. This is what we call the dividend snowball. You do this for several years and you're going to make a lot of money. And this is what I do. And I've been doing this for many years. So it works. Next one. Visa. We've all got Visa cards in our wallets. I probably have one too many, and sometimes I'm spending a little bit too much time overusing my Visa and spending time paying it off monthly to the best of my ability. I have a love-hate relationship with Visa. Visa's a pricey stock. It's over $200 a share. You would think that this is a financial company or a financial services company. This is an IT company. They were founded in 1958. They're headquartered in San Francisco. Their focus is what we call payments technology, and they operate all over the world. They serve consumers, merchants, financial institutions, government entities. You can do more research on Visa, but we've all heard of it. We know what it is. The dividend yield is low, but look at that dividend growth rate, almost 18%. The payout ratio is low, not even 21%. They've been growing their dividends for 14 straight years. I love this stock. I have several shares of it, and I've had them for years, and I'm continually dripping every quarter. Ex-dividend date is February 9th, so if you want to get in this quarter, you need to move. If not, I would advise you to take a look at buying it anyway. Visa's not going anywhere, folks. They're going to be around a long time. They've been around a long time. Look at that beta. It's 1.0. So this is not really a volatile stock. And I'll tell you that looking at my portfolio, they've been one of the best performing stocks. They are growing regularly, and I'm getting my dividend every quarter, and I love it. All right, next one. Con Ed, Consolidated Edison. Well, this is a utility company, and this serves the greater New York area. They primarily sell electricity to industrial, commercial, residential, and government customers. They were founded in 1823. Now, that's a long time, and they're based in New York City. They serve approximately 3.5 million customers in New York City, Westchester County. They deliver electricity, gas, so gas to about 1.1 million customers in Manhattan, the Bronx, Queens, Westchester County, and steam. Wow, to over 1,500 customers in parts of Manhattan. They also serve parts of southeastern New York State and North Jersey. They really cover a lot of ground. It's really quite fascinating. What I like about this is that this is a very low risk investment. Look at that beta, 0.3. So compared to the S&P 500, there is very, very little risk and price volatility. You're going to tend to see that in a lot of utilities. PE ratio is a little under 20. It's probably a little bit high, but for utilities, a lot of folks that are looking for something stable and safe, and they want a greater return than putting something in a high yield savings or checking account, this might be the thing. So they're going to pay a little more for it. Market cap is about 33 billion. It's not a bad dividend yield. It's a little around 3.5%. Dividend growth rate is less, about 2.75%. So what are we looking at? Total around 6%. So you're going to give up a little dividend yield and growth for some stability. But I would say the thing that stands out for me is that dividend growth streak of 48 years. That is really impressive. They've been around, and they've been serving their customers and their investors, I should say, with steady dividend payments. They're a dividend aristocrat, and they are 2 years away from being a dividend king, and they're going to make it. This is a quarterly dividend company. The payout ratio is in that sweet spot of 66%. I can dig that. And they're going ex-dividend on February 14th. I don't have any of this yet, but it's on my buy list. And the price, I think, is a decent price. It's very affordable. Con Ed, ticker symbol ED. Next one. Microsoft. You typically don't think of Microsoft when you think of dividend growth companies. But this is on the list for a number of reasons. Well, it's going ex-dividend date this month. But it's a world-class company. They've been around a long time. They've made a lot of money. They're continuing to make a lot of money. Listen, we all use Microsoft software. It's on our laptops, our PCs. They're on Macintoshes as well. They're into all sorts of handheld devices as well. They got tablets, and they're really everywhere. And you know what I love about this company? They got captive audience. They got great subscription revenue. Their cash is absolutely phenomenal, and it's growing. And this company is looking to continually grow. You've been reading about AI or artificial intelligence. They're looking to branch out into some of these other areas. And we've heard that they're making investments in OpenAI. We also read that they're looking to get more deeply involved in building out the metaverse, and they're looking to buy. I can't remember the name of the company. I think it's called Blizzard or something. You can read about it, but this is a company that is not standing still. They haven't really innovated a lot in 20 years. They do innovate more than most companies, but not like they did 40 years ago. I think that they're going to innovate like that again, and they're going to change really the world. They're going to be part of that next generation of the digital revolution. Looking at the metrics, the yield is low, but they have a beautiful growth rate, a little under 10%. Payout ratio, they're not straining to make these dividend payments. They're under 30%. They've been growing their dividend for 18 consecutive years. They're 7 years away from becoming a dividend aristocrat. They're going to make it. This is a phenomenal world-class company. The beta, interestingly, is a little less than the S&P 500 at 0.9. Look at that market cap. They're huge. They're a $2 trillion company. This is one of the largest companies on the planet. They're going ex-dividend on the 15th. All right, next one. Last five. JPMorgan Equity Premium Income. This is what we call an exchange-traded fund or an ETF. So it's not a stock of a company. It's an ETF, which is it's a basket of companies that JPMorgan manages and invests in for us. And we've seen an explosion the last few years in ETFs. ETFs have been around for about 30 years. But I'd say in the last 5-10 years, they've really been growing and growing and growing. This one is only 2 years old, but they've made a big splash in the industry. What I love about this is that this is fairly inexpensive. It's less than $55 a share. When you look at market cap, you're not going to see that here because it doesn't make sense for an ETF like JEPI or any of the ETFs to have a market cap. They don't have their own market cap. They're managing investments in other companies. So the metric is assets under management, and they have over 20 billion. That's pretty impressive. Their expense ratio is about 0.35%. That's a little bit more pricey than some of the bigger ETFs like the Schwab Dividend Income ETF, which has a 0.06% expense ratio. But I think that this one, they have to work a little harder because there's other layers of complexity in managing this with covered calls as well. And I'm going to get into that probably in another video. I'll do a deep dive into ETFs and I'll talk about this one. This is one of my favorites. I have several shares of this. What I really like is the dividend yield. You can buy several shares and get a nice yield for your investment. So let's say you buy 100 shares, about $5,500. You're going to get $642 in dividends annually. And the expense ratio I mentioned is 0.35%. If you invest $10,000 in this, you're going to have to pay $35. That's not too bad. If you were to buy Schwab, it's $6. So we do look at the expense ratios. That's a way to compare them and compete, but you have to look at what's offered as well. And this is a little bit different than some of the other ETFs. The dividend growth rate is really high, but again, this is only a 2-year-old ETF. I would expect that will normalize a little bit. They've been growing for 2 years. And you know what? I love the fact that this is a monthly dividend ETF. So if you are trying to space out your dividend income, this can maybe be a solution to help out. They've already gone ex-dividend for the month, but I would say go get them if you're interested. I got them. I did paste in the bottom a list of some of the key holdings that JEPI has. They have Progressive Core. They have a JPMorgan U.S. government mortgage securities, ExxonMobil, Hershey, MasterCard, Bristol-Myers Squibb, AbbVie, which I also have. It's a wonderful pharmaceutical. Comcast. They have Visa, which we just covered. That's part of JEPI. U.S. Bancorp. These 10 stocks account for about 15%. And you know what? What I like about that is there is not one holding that really dominates the holding. You're not going to find any one of these that is 25 or 30%. The benefit of these ETFs is that they've worked out the diversification for you. So you don't have to worry about investing in stocks. You can invest in ETFs if that's not your thing. I love to invest in stocks and ETFs. So I'm kind of in hog heaven. All right, let's go to the next one. Walgreens Boots Alliance. This basically, if you've gone into drugstores, you're going to see Walgreens. They are really in many places around the country, and I live in the South, and I see them everywhere, and in the Mid-Atlantic. They've been around a long time. One of the things that sticks out to me is the low beta. it's less than 1, and the PE ratio is only 8. Nice market cap of 31 billion. They've been around a while. The price is not expensive. It's 36 bucks a share. Nice dividend yield of 5%, dividend growth rate more than 4. So together, those are about 10%. And that combined with the low beta and I would say a very reasonable PE ratio, that's very nice to have. This is going to be a stable investment. You know, you're not going to make millions of dollars investing in Walgreens Boots Alliance or ticker symbol WBA, but you will make money. They have increased their dividend steadily for 30 consecutive years. It's a quarterly dividend company, and they're going ex-dividend on the 15th. Number 3, oh, I love Lockheed Martin, ticker symbol LMT. This is a pricey stock. It's 468 bucks a share. Big market cap, almost $120 billion. PE ratio, I could stand for a little bit lower ratio, but the beta is low. And in the end, I think that this is a great investment. Let me just say a little bit something about Lockheed Martin. You know, we live in a dangerous world. You see what's going on with the Ukraine and Russia's invasions of the Ukraine last year. We also see the incursions of, you know, China and the threat of potentially invading Taiwan. We hope that doesn't happen. But the world is dangerous, and you know, we always need to be prepared for the worst and hope for the best. We want peace, but regrettably, we live in a dangerous world. So I think that investing in companies like Lockheed Martin, Northrop Grumman, and Raytheon, which I have in my portfolio, are prudent investments. What I like about Lockheed Martin is it's got a healthy 2.5% dividend yield. I'd like for it to be higher, but I'm okay with that. It's really a dividend beast, though. When you look at the dollars annually, it's 12 bucks a share. You know, you're spending a lot, so you're getting more than you would back normally than with other stocks. I really like that dividend growth rate. It's a little under 9%. So combined, the two are going to be around 11 or 12%. It's more than its its competitors in its sector. They're easily meeting their dividend payout ratio. It's less than 42%. And you know what I love? Look at this dividend growth streak. 20 years they've been increasing their dividend rate for 20 consecutive years. This is a quarterly stock company, and they're going ex-dividend end of the month. Something to look into. I have several shares, and I look to buy more every chance I get, and I'm dripping every quarter into my Lockheed Martin, and I'm growing my my holdings in this wonderful company. Oh, this is one of my favorites, Chevron, ticker symbol CVX. This is a pricey stock. It's 174 bucks a share. PE ratio, it doesn't seem to be particularly high. It's a little bit higher than some of the other oil and gas companies that we talked about, like the ConocoPhillips and the Valero. But the market cap is huge. It's 328 billion. This, I believe, is the second largest oil and gas company in the world. The largest is, I want to say, ExxonMobil. ExxonMobil could have been on the list because they're going ex-dividend this month, but I want to keep the list. I don't want it to get too big. I actually used to own ExxonMobil. I love the company, but I did do a closer look at ExxonMobil and at Chevron, and I think that Chevron's dividends are a little bit more generous. However, I'm looking to get back into some ExxonMobil because I think it's a good time with the oil and gas companies. I think I talked about the dividend yield. It's 3.5%. The dividend growth rate is a little bit more than 6, so that's going to get you to 10. You know, easily meeting their dividend of 30% with a payout ratio of 30%. It's right in that sweet spot. The dividend growth streak, this is really impressive. 35 years. Chevron's a dividend aristocrat. They've been doing this. They've been an aristocrat for 10 years. They're 15 years away from becoming a dividend king. They keep going the way they're going. They're going to do it. They're going ex-dividend next week. If you're not in, something to look at. And then last but not least, number one, and I did mention this stock at the beginning, Johnson & Johnson, ticker symbol JNJ. To me, the thing I need to mention first is that their dividend growth streak is 60 years. They're a dividend king. They've been doing it for more than 50 years, increasing that annual dividend. It's a little bit pricey. It's $163, but look at that market cap, $427 billion, and it's a low beta. You know what? You look in your bathroom and in your medicine cabinet, you're going to see a lot of product that you probably have from Johnson & Johnson. Shampoo, baby powder, who knows? There's tons of stuff that you buy and you might not even know it's Johnson & Johnson, but they have such a wide array of products. They're not going away, folks. They're going to be around a long time. Dividend yield a little under 3%. Dividend growth rate, I love it, 6%. So they're steadily increasing. So just being an investor and holding, you're going to make money. Payout ratio is 43%. They're making that dividend payment easily without any problem doing it. It's a quarterly dividend company. They're going ex-dividend on the 17th, so you got about a week and a half to go ahead and get in if you're not in. I have had it. I have sold it. I'm looking to buy back in. I think that this is an absolute wonderful company for the long term, and I look forward to buying more. And that ends my list of my 16 stocks. There are more, but these are the ones that are going ex-dividend in February, and I wanted to share those with you. I want to give you the disclaimer again that I'm not a financial advisor. Purpose of this video is for education and entertainment, and it reflects my own assessment of these investments. These are my own opinions. So do your own research and consult a financial advisor prior to making any investments. I have a financial advisor, and I do that. A lot of times we agree, and I like to bounce my ideas off of them. Sometimes we disagree, and I overrule them, and I do my own thing. And I've been pretty good at this, and I love doing this. So I wanted to share this with you. And I thank you if you've stayed for the entire video. I hope to be doing more videos soon on dividend growth investing. And I'm looking to build a community. So I would ask that you please like the video and hit the subscribe button and hit the notification button. So when I send out new videos, if you're interested in listening, you'll know. And I do appreciate your time. Thanks for taking this wonderful journey with me. I wish you the very best, and we'll be talking soon. Take care and God bless.